Good morning, everybody. Welcome to Wednesday webinar. You are halfway through your week. And this week, guys, we brought in a gentleman that is going to talk about something that I think we are underutilizing. I think would be fair to say. I introduced to Guaranteed Universal Life probably 3 or 4 or 5 years ago. And I believe it is one of the greatest products to come across the market in the last 20 years because it meets the need. If you're selling term insurance, what's the number one complaint you get? Well, what if I don't use it? What if my term runs out? GUL is here to answer that question. It's for somebody that doesn't necessarily want to grow cash value, but also wants permanent protection. So I'm going to turn it over to Paul Gannon. Paul is the Vice President of Business Development there at First Heartland, one of our partners, and he's going to take it away and tell us all about Guaranteed Universal Life. Paul, thanks for coming on, man.
You bet. Thank you, Dallas. Appreciate it very much. And good morning to everyone. Thanks for carving out a few minutes to chat this morning. It's good to be with everyone. And as we were talking a little bit before we started the recording, it's colder in some places than others. It's about 12 degrees here in Denver this morning. So I'm going to do my best to stay warm and get through this. So good to be with everyone today. As Dallas said, we're going to talk a little bit about GUL, or Guaranteed Universal Life. And I agree with Dallas's comments on there. I think it's underutilized in the marketplace and it has a definite fit. It's got some real nice features to it that I think can make it very appealing in some of your casework and some of your design work. So with that said, I will go ahead and just kind of buzz through the agenda here real quick. We're going to talk a little bit about the when and the where GUL might fit, where it fits for kind of the best features that it offers. I'll talk a little bit about some of the basic characteristics on GUL. When I was an agent, I was always looking for things that were useful to me on the day that I received the information. And I plugged in a couple sales concepts here that hopefully you can plug into your practice and walk away with on today. And then on one of those sales concepts, I've got a case study, and we'll dig a little deeper on one of my favorite sales concepts that we'll chat a little bit about in the case study. So that's kind of what we're going to look at today. I won't keep you too long, but I think we got some good stuff in here for you. So we'll take a look at the when and the where. In life insurance conversations, it's always important that we get the death benefit protection and we establish that need first. GUL is no different. It's a life insurance product. We want to go through there and make sure we establish the need first, and then plug in the GUL and what it can do up and above just offering a death benefit. It is excellent in the estate planning forum. GUL has the fully guaranteed features on there. So estate planning needs, when you're talking with people, whether it's to create an estate or protect an estate, GUL can jump in there and certainly fit the bill there. Lots of the products on the GUL side now offer the long-term care riders. Whether it's chronic or critical, and terminal is usually on there. That can be a huge bonus in conversations where you're looking at the death benefit, of course, but there might be no long-term care planning that has been done. So there's a lot of good options and opportunities on the LTC side in the GUL conversation. And if you're working in the business markets, GUL is an excellent product to talk about with business owners who are always very value conscious on what they're doing and bottom line oriented on their conversations. Don't forget about GUL in business planning conversations. I'll talk a little bit about the opportunity in the business market right now, which I think is an unbelievable opportunity. If you're not working in the business market right now, I think it's a good time to maybe start working that into your business plans for 2023, because I think the opportunity in business planning is enormous, and GUL fits right into those conversations in business planning. Some of the characteristics, if you're familiar with GUL, if you're brand new to it, it is flexible in design. It does sit on a universal life chassis, so you do have the flexibility that is inherent in universal life along with the guarantees on it. So it's kind of a double there that you get with it, and that flexibility, people really like more flexibility than less, I find, in conversations. So the flexibility and design on the UL chassis is where it all starts. Typically, it is a lower cost for a permanent solution. And when I say typically, if you were comparing GUL to maybe IUL or VUL, in the best case scenarios, GUL will typically come in lower in most cases with the fully guaranteed. It doesn't have, like Dallas mentioned, it's not big most times on the accumulation side, but pricing and guarantees for the death benefit, which is where you want this, that's the sweet spot. So lower cost typically for a permanent solution. And the dial a guarantee on here on most of the products, you usually in that range from anywhere from age 90 to age 121. And this comes up a lot more in conversations, even from when I was in the business to now. People are just generally living longer, which is good news. And you have the ability to move that guarantee on most product chassis between that 90 and 121. If there's longevity in that family, yeah, my grandparents are both in their late 90s. They play golf 3 times a week. They bowl 300. Great. We're looking more towards the 121. We're going to move that over. We're going to bring the premium up a little bit, but we're going to have that protection there. So they're not going to have to worry about that longevity in there. And then on the other side, for example, in my family tree, if anybody makes it past 60, we're having a party and you're all invited. So you can bring that back down to 90 and lower that premium. So if you're in a competitive situation with another agent or someone else is showing them something and you need to move that premium down a little bit, you've got that flexibility to do so. So that's a real important feature, I think, characteristic wise on the GUL. And lately, I think this one has really come into vogue. Is it is not a market-based contract. So you're not beholden to anything to do with, whether it's a sub account or anything in an indexing strategy where you're beholden to the market for returns on it. This is not a market-based contract. I think it makes it more popular with conservative clients or people who are just very market adverse right now, which I think there's a lot of that because of the wild swings we've been witnessing here in the last few months. So not market-based contract, I think, is important in that conversation with that more conservative client. Some of the players in the market here, and this is more on where First Heartland is seeing where we're coming out competitive lately in the numbers we've been running. So we're seeing quite a bit of North American, Protective Life, Nationwide, AIG, which is now Corebridge, and Banner Life, all in the market, all offering a very solid product. And it varies from product to product. There's other players in there for sure, but this is just what we've been seeing most lately. I promised you a couple of sales concepts, and hopefully we can plug in a couple of things you can use in your practice, walk away with it today. So first sales concept I've got on here, and Dallas touched on this just a little bit in his opening remarks too, and I love this, is the combination sale with term. And again, this comes into play with your value conscious clients, whether it's business planning or just individual planning. Once the death benefit need is established, life insurance, we always do that first. You can position the GUL alongside a term policy to hopefully meet the overall need while keeping the premium costs down. So in this example I give here is a female, age 45, standard non-smoker. And we've determined your open-end questioning, however you make your determinations for coming to that death benefit. This particular individual needed $1 million. So kind of partnering up the term with the GUL. In this instance, based on her age at 45, I was comfortable putting a 30-year term in place. Always look at the conversion options on that term you're plugging in as well. It may be something you can offer later if there's a conversion opportunity. They want to make more of it permanent. Double check that too on the front end so you know you've got conversion options in there. That might be something you turn to later. So the death benefit, as you're reading across the little grid there, we do $500,000 on the 30-year term, and that comes out to about $105 a month and about $1,260 annually. And then we pair that up with the GUL. I went the guarantee on this one to age 100. They were comfortable in that with the longevity in her family. We look at it that way. $500,000 death benefit. We're at about $351 monthly or $42.12 annually. And that totals out about $54.72. In the comparisons I was doing with this versus other permanent solutions, this comes in way lower premium wise. So I think the GUL as a combination product with term, whether you do 30, 20, or even 10, is an excellent sales concept with that GUL because of the pricing on there and the dial-a guarantee where you can kind of move it around a little bit. So it's a real nice fit. They complement each other very well. And again, as always on the term, double check your conversion opportunities because that might be something that could come into play in the next couple of years. Second sales concept I put in here, and I'm kind of putting a lot of emphasis on business planning because I think the opportunities are just so great, and this statistic would kind of bear that out. Only this is a LIMR statistic too. Only 47% of business owners have a formalized plan in place to transition the ownership. So if you're talking to business owners during the course of the week, half do not have any kind of plan in place at all. And if, again, they're value conscious and value oriented, the pricing on that GUL is going to jump right in there too, because you're offering that permanent solution and the cost typically lower than what they might expect. And even if you run into somebody who has some planning done, 26% of them haven't even reviewed their own plan in the last 2 years. So you can step right in and offer that no obligation review, as it were, on the plan that they might have in place. There might be some updating that needs to be done. Maybe there's been some big growth in the business. They've added more employees, whatever it is. 2 years having not had a review is a long time in today's world. So the business market, again, great opportunity just for you in growing your practice, but in offering GUL in that too, super time to do it. When comparing life insurance options, the permanent solution can cover well beyond the term. So many times when I was working in the business market, they'd say, well, we just want 10-year term. It's the cheapest. They look at that number. That's what they want. I would say sometimes, well, are you planning to be in business longer than 10 years? Well, yeah, I'm turning the business over to my kids. They're going to be running it. Well, then let's take a look at maybe running something beyond 10 years. So you don't have to keep doing this, every couple of years and adding new term to it. So the costs on there, many times, term to age 100, term to age 121, you can kind of position it in that type of language. And although term is altogether cheaper, it doesn't provide that long-term solution. So if the business owner is planning on being in business, you need to talk about the permanency of that kind of planning for business continuation. So business planning, GUL, I think it's a great time to be talking about it with people in the market. My third concept on here is when I came into the business, we called it annuity maximization or annuity max. And the case study I've got in here is going to dive into this one a little bit more deeply, but I think this is an excellent concept. It's tried and true. It's been around for a while, but it's still very, very effective. So if you're doing your interview with the client, you're going through your questioning and you kind of discover there's an annuity out there, don't run away from that asset. Definitely run right towards it. A lot of times as agents, we have a tendency to think, oh, well, they've got that annuity. They already know what they're doing. Many times, not so much the case. If they've got that existing annuity, you can maximize that feature that annuity does better than any other product in this sense is income guaranteed for life. And we can turn that into an income stream potentially to fund a GUL contract. So you use the income, all of it or some of it, that spins off from the annuity contract, from the existing asset to fund the GUL policy. This immediately creates leverage for estate planning purposes. If estate planning is paramount in the planning process here, it creates a larger tax-free death benefit right out of the box. So annuities do things very well in the form of generating lifetime income, but not so good in wealth transfer and estate planning. Life insurance is a much more effective tool. I would argue the absolute best tool in the business for wealth transfer would be utilizing life insurance. And you're immediately raising up the amount of tax-free death benefit that can go to the heirs by funding that life insurance contract. So if the GUL offers long-term care riders as well, you may be creating that long-term care plan where none had existed before. So in many instances, you might be knocking out two things in one here just by talking about the GUL. I think the stats I saw on LIMR's last year, they do a study every year and they talk to people about kind of what's top of mind. They ask them, what are you thinking about most? And the number one answer, again, I think this is 5 years in a row on this, is long-term care. And what's gonna happen ultimately with me, because right now I'm in a long-term care situation with one of my parents or my grandparents, or there is someone in their world that is having a long-term care instance. And by bringing that up and then maybe potentially talking about the riders, you can be creating their entire long-term care plan just by offering the GUL chassis with the long-term care riders on it. So big opportunity to add the long-term care riders on there on the GUL. The chassis is already a little less expensive, so putting the riders on there typically keeps it reasonable, but it offers that long-term care plan maybe where there wasn't one before. And that stat we had about the business owners not doing a lot of planning, I think you'll find when in your conversations with people, if you talk to 10 people this week and ask them about their long-term care plan, there probably isn't one. I'd say 9, maybe 8 out of 10, no plan at all. So you're bringing tremendous value in that conversation by bringing up long-term care along with the life insurance for the tax-free death benefit if estate planning is top of mind as well. So annuity max or annuity maximization, really, really good sales concept. And I think it's applicable just as much today as it was years ago when I first saw that one. So we'll take a little bit deeper dive into the case study on this. Thanks to our friends at Nationwide who provided this sales piece here, which I thought was really good in talking a lot about the annuity max. On here, they call it wealth transfer with long-term care rider. And on this, basically, it's just going to dive a little bit into the annuity max sales concept that we were just talking about. So reading across the top here is, do you have clients who have a fixed annuity and don't need it for retirement? Well, we mentioned that if you come across that asset in their portfolio, this might be an opportunity. Are these clients concerned about long-term care and costs? Just about everybody is. And would they like to leave legacy for their beneficiaries? Most people do. Most people are very benevolent when it comes to planning, whether it's for kids, charity, their church, wherever they want that directed. If you can ferret out that need for them, you're on your way in this concept. So toward the middle here, it's just a little bit about how it works. And we'll look at the numbers here on the next slide. So you're looking at the input on here. We're going to take a $100,000 fixed annuity. And from that, it kicks out $10,105 a year just for the income portion, guaranteed for life on the annuity. And then the output on this, as you move to the numbers a little bit to your right there, we'll put in $216,220 of long-term care benefit, or a total of $4,324 a month. Again, if there was no long-term care planning that had been done at all, this is huge. This is a big plus, a big value add that you're bringing to the client when talking about using maybe an asset that they hadn't done much planning with and suddenly creating the potential for long-term care benefit that they had no planning at all, along with a tax-free death benefit. Pretty cool stuff. So the numbers, as we bear this out a little bit, as the case study comes into focus a little bit. So we have Anna, in this case, is a 55-year-old female. She's married and in good health. She's comfortable with her current assets. She's doing pretty well. And that will cover her living expenses for retirement, but is concerned about possible long-term care costs, like everybody. And Anna has 2 adult children, and she would like to leave some small legacy planning to make their lives a little bit more comfortable. So there's some benevolence there as well. Anna purchased a $68,000 fixed annuity several years ago and is now out of surrender period. Currently, the annuity is worth $100,000. The earnings guarantee on it's about 3% is what it would be worth. So as you're kind of looking at the numbers here, the option, I'll go down to the option portion here. Anna can annuitize choosing a 10-year term certain option, which would generate the income at approximately $10,105 for 10 years, fully guaranteed. She can use a portion of the distribution to purchase, in this case, the Nationwide No Lapse Guarantee UL with a long-term care rider, and retain the rest to pay for taxes due to the distribution. So if you look at the numbers in the middle there at the top, if she annuitizes 10-year term certain, annual income, again, $10,105, taxes in all years, $992. So after tax is $9,113. And that's probably where you're going to want to look at that number to see what we've got for potential premium, is kind of an after-tax look at it. So some of the summary stuff on the policy benefits, the annuity value, if held until death or age 80, would be after taxes about $166,965. Now remember, she wants to be able to give some money to her 2 grown kids on here too. So if we don't use, or if we use the long-term care benefit in that second one there, moving to the right, Nationwide benefit, no long-term care received, you'd have $216,220 tax-free death benefit. So there's that leverage on creating a much larger estate just by having the income from the annuity spinoff and pay for the life insurance contract. And if she does maximize the long-term care rider, which, we hope that doesn't happen, but if it does, it's there to protect her, and it still would leave a little over $20,000 in tax-free death benefit, even after she utilized the entire amount for the long-term care event, whatever that might have been. So it creates the leverage on the death benefit immediately and does provide the long-term care benefit if needed later on. So that annuity max kind of brings together the best of both worlds, with an annuity providing the income, which it does better than any other product, lifetime income guaranteed, to a life insurance contract, in this case, GUL, which is guaranteed to age 100 or longer if needed, with the long-term care benefit. So it's a nice combination of pulling assets together on the annuity max. I love to see it. I used to see it a lot. Wrote several of these back in the day where we were doing that kind of funding on it. It worked great. And people are typically very happy. And I think now with that conversation on long-term care as top of mind as it is with most people, being able to kind of bring that into GUL makes a lot of sense, I think, in that conversation too. So there's your three sales concepts. We've got the combo with term, we've got the business planning, and then the annuity max. Hopefully that puts some thoughts into your mind when you're having some conversations with clients, and maybe that'll be something you can kind of plug into your practice today. Dallas, I don't know if we kind of open up for questions a little bit, or if we want to chat a little bit on this. I'm not sure how we are on time. And I think Dallas is muted right now. I don't have a chat box, and I don't know if you guys can take yourselves off mute, or if Dallas has to do that. But we can certainly go through some questions if there are any.
Paul, we can take ourselves off mute and
Okay.
have the chat box. If anybody wants to put a question in the chat, I can read it out to you.
Yeah.
Awesome. That'd be great. Thank you, Josh.
Paul, with that last example, you're basically using the living benefits for the long-term care, right?
That's correct. Yes.
So obviously, if you didn't use all the living benefits, there would still be more than the 21,000.
Absolutely. Yeah. That looked at it from the scenario if you used everything to the absolute maximum. But yeah, that's a good point. So if you had, say, 1 year of care as opposed to maybe 3, those numbers would significantly be higher on what is left over. Yeah, great point. Good question.
Paul, what's the best way for somebody to get a design if they have a client?
I think the best way to do it, we take a look, give us a holler. We're happy to run some numbers. We may run, 1 or 2 different comparisons for you too. If there's something particular on that long-term care rider you're looking for, maybe you needed to do something different than maybe, or a little unusual. But I would say just reach out to, you can call me, my number's up on here, or shoot me an email. And marketing will be happy to run some numbers for you and look over the case with you.
And Paul, do you mind if I run a quote here real quick and just kind of show them how to do it? Because most of these folks have access to First Heartland. So you care, if you'll stop sharing your screen, I'll share mine.
Sure.
And then while I'm doing that, they had a question. What's the difference between a GUL and a GIUL?
Well, if you've got indexing in there, then you're moving out from a fully guaranteed non-market participating contract into an indexing product, which does bring the market into it for maybe a little bit higher upside, if that makes sense. So this would be GUL. Pure GUL is non-market based product. And once you put the I in there, the index word, then you're going into a market-based product. So that would be kind of your difference in there, if that answers your question.
So guys, this is First Heartland's website. If you don't have access to this yet, let me know. Shoot me a Slack message and we will make sure you get access to this. But you're just going to go here to insurance, go down to quotes and illustrations. I'm going to click on it. You can go over here, but I'm going to click on quotes and illustrations. And then I'm going to go down here to term quote engine. And I would say if you're running something that has long-term care benefits and something like that, I would say that go ahead and reach out to Paul and his team and they will put together a more detailed illustration. But if you're just looking for a simple GUL, it's not hard to do. So it's a lot for some reason, my computer's going slow, but let's say we've got John Doe and let's say his date of birth is 3/10/1978. Seems like a good year there. but we'll go male here in the state of Missouri. Now, right here is where you'll go for term or GUL. So I'm going to go down to GUL there, and then I'm going to leave it at all products. I'm going to do a couple maturity ages. Let's say 90, 100, and 121. And let's say we're looking at 250 and 500. And here's all the riders, but we'll leave riders off today. We're just going for basic coverage. Paul may not like it when I say this. I call this my glorified term. The only difference between this and a term is instead of 10 years, it's going to age 100 or 120 or whatever. And then let's say we know his health class is a preferred non-tobacco. Okay. So then it's going to run that. It's always going to come up annual premium. I switch over to monthly, but right here, you'll see here's 250 to age 90. So I'm going to build a spreadsheet for my client real quick. 250 to age 90 is 159.75. To age 100 is 173. To age 121 is 184. Now, Paul, correct me if I'm wrong, but if I can, I'm trying to get them to go 121 every time, because if they live a day past 90, that policy's gone. Is that correct, Paul? And 121, it's actually paid up.
Correct. Yeah, you're looking at an endowment in a shorter period. That's why when you're talking about longevity in the family, it's real important to get that right. But yeah, using it typically 100 and beyond is what we'll see most of the time.
Right. So I'm going to go back here and I'm going to select different ones here. And then I go up here to download. I'm going to run a list report, and that's going to build out a spreadsheet that I can then show to my client. And then I can say, okay, if you want it to age 90 for 250, it's this much. If it's to age 90 for 500, here's the numbers. And I can go on down through here, and here's just a nice little spreadsheet. And the nice thing about this is, guys, if they say, you know what, we want to go with the age 100 to 250, I just go back here, age 100 to 250. American National is a just-in-time product. I click apply, and there you go. There's my papers. I don't know why American National doesn't have an e-app, do they?
They do not.
Okay, yeah. So I would say, you know, Protective is a great company, and I would look there, and there's my drop ticket with an e-app right there. So, but yeah, it's that simple, guys. And like Paul said, where I've sold, back when I was in the field, when I sold the most was when I would pair it with a term. Because think about, like myself, for example, I've got, I think, 1.5 million in term, but then I bought $100,000 GUL because I've got two girls at home that are 15 and 17. They will be out of the house here in 4 or 5 years, right? Or I'll move the house. You know, I want to get them through college. I want to get them married off. My life insurance is there for that. So I've got big needs right now. I've got a home that I still owe on, stuff like that. And this is also probably my biggest years of income earning. So I needed that big amount right now. But in 15 years from now, hopefully, I'm not going to need 1.5 million in life insurance, right? I'm putting into other things that's growing and stuff like that. But I'll always need that little $100,000 policy that'll be there till age 121. And so it just gives me the big protection now, and then it drops off without paying that exorbitant price of 1.5 million on a GUL or something like that. So that's where I've been pretty successful in pushing that. So would this be appropriate to offer for a final expense client who is looking for more than what they final expense can offer? Absolutely. I'll let you talk about that.
That's a good market, and that's a good question for it too. And some of the face amounts too, you can bring those down closer to what I would call a traditional final expense, you know, maybe 50,000 or in there, and just see which carrier meets that lower face amount. But yeah, in that marketplace for final expense, I think GUL does a super job.
Yeah. And the only other thing, I've done that a couple times. For example, if you've got somebody that's got a $30,000 final expense policy, you could probably get them a $50,000 GUL for less money. It would probably be less money. Now, remember though, it's not growing cash value. So it's just pure protection. But the other thing about it is, and the other negative, they will have to go through a physical, most likely. If they're in their 60s, 70s, they're gonna have to do a physical, whereas a final expense, they're not gonna have to. But it's going to be less money. But yeah, we run into it all the time, right? Most final expense carriers go to 30, 35,000, and GULs can go down to, I think 50,000 is the least I've seen it go down to. But I mean, even 100,000 is going to be comparative to 30, 35,000 in the final expense world.
Yeah, because in that final expense, the carrier is kind of, since you're not having the physical and all that, they're baking that into the pricing. So the pricing, like Dallas said, is going to be sometimes higher than what you could get on 50,000 GUL, which is kind of amazing. But if you can take the time and, you know, make it through and get, you know, decent underwriting on it, well worth it.
Absolutely. Any other questions? Is there a replay available? Yes, Kevin. We've recorded this and we'll be putting it on our AMS. So in our library. So yeah.
James had a question in the chat there. What states are these products offered in?
Everything but New York. I'm just kidding. There are some products available in New York, I believe. No,
New York's always the tough one.
Yeah.
I live and breathe it. I know all about it.
Yeah. Absolutely.
But there is a list of products. Sarah put a list of products together for me that are available through First Heartland in New York. I can send that to you, James.
Awesome, Josh. Thank you so much. I appreciate it.
Put your email in the chat and I'll send it over.
And be sure and just go on that First Heartland site and play around with it. Look around, see what you can find, see what you can figure out. There's a lot of cool stuff. It's pretty neat what you can do on there. So, and Brian has done some good recordings on that as well. So, all right, guys, any other questions before we get off here? All right, well, guys, thank you very much. Paul, thank you. Great job as always. And we're going to let you guys get out here and get out there and write some GULs.
Have a great day, everybody. Thanks, Dallas.
We'll see y'all.
Thank you, Dallas.